Hello, welcome to our 2026 winter market update. Michael, good to see you.
Happy New Year.
Happy New Year.
How's it going?
Good. How were your holidays?
Good. Really good. Good time with family.
Yeah.
And took a little bit of time off, so glad to get this new year started. Talk a little bit about last year and what's ahead.
Absolutely. Well, let's just go ahead and jump right in. We want to kind of start off by just kind of looking back at last year, and it's definitely a very interesting year. This is actually a slide that Michael we've shown before. And it talks about just major asset classes, but one thing I'll just highlight really quickly is the April 8th dip to where we ended the year. It was quite a rebound. And Michael, if you want to just talk through your key takeaways, and when you look at this slide, what do you see and what stands out to you?
Yeah, it's lots of interesting things. I mean, you've got international dipped only 3% and ended up for the year 32%, and then you had small cap dipping almost 21% and ending the year only up about 13%, which would normally be a great year for small cap. But with large cap being up 18% and international being up above 30%, those are just very meaningful differences. So we'll come back to asset allocation here later in the update. Bonds also very interesting. Hardly dipped at all, if any. Was up 2% through the first few months of the year, and ended up 7% for the year if we use the aggregate index that we usually use. So yeah, just quite an interesting year for asset allocation. I think it's really important. I saw an article in the Wall Street Journal later in December, which talked about all asset classes did pretty well. But the important thing to remember is we really need, in years like last year where equities performed generally very, very well, that just helps us as investors run that much further ahead of inflation. So if sure, cash and bonds did well last year too, but we really need to have these huge gains to help kind of run past inflation if we're really going to protect ourselves from that risk. So that's something that obviously we talk to clients a lot about. The other thing I was thinking about, just kind of last year's large cap really outperformed small cap for most of the year. Small cap made some gains later in the year, and then really in the last month or so, large value and some dividend stocks have outperformed large growth stocks, whereas for most of last year, large growth stocks outperformed. So you're always going to see some rotation here and there, which is why we include a little bit of several of those items in most clients' portfolios.
That's great. Michael, do you want to say anything else about growth versus value, or just detail that for people that may be wondering the difference even in those two?
Yeah, growth stocks obviously being stocks, companies that mostly reinvest in themselves. A lot of value stocks, they may not have new ideas, but they're pretty cash flow positive, have good profits, pay out dividends, not all of them. And so certainly just different asset classes. What you really start to see is we're going to talk about good decades and bad decades here in a minute, but you really start to see large value outperform large growth during the rougher, more volatile, lower performing decades in stock market history, which is not where we are right now. So still paid attention a lot to those different asset classes, different parts of the portfolio. Don't ever want to hedge too much. I think for the most part for our clients, it's profited nicely. They profited nicely for us to be a little bit overweight international and be a little bit overweight large growth. But that's something that we're paying a lot of attention to. We'll talk about that in reference to good decades and bad decades here in a minute.
That's great. Yeah, for international, it's almost double. The S&P is obviously quite interesting, and we'll come back to that here in just another slide or two. So,
Kevin, what's also very interesting with this slide, you and I were having a conversation about this the other day, is so many of the predictions from Wall Street firms in 2025 are so far off. And it just goes to show you have to be so careful with whether it's marketwatch.com or CNBC. You almost have to watch it a little bit for some information, somewhat informational, but mostly entertainment value. Stay informed, know what's going on out there, but we have to be really careful about whose predictions we're listening to. So we'll talk about that as we get into kind of what we're thinking about with 26.
Absolutely. Yeah, if you were watching the news, you probably thought in April it was going to take years for your portfolio to rebound, and to see the end results is quite fascinating.
Yeah.
Well, let's move on. This is actually a slide we actually showed in our last update. But a lot of times when the media really is, talking about where the market sits, they talk about how things are currently overpriced. So this is a slide we don't put all of our eggs into this basket, but we like to look at this, and one of the many things we are looking at. But Michael, what does this slide say to you, and what really stands out?
Well, it certainly stands out that in March of 2000, the price earnings ratio on the forward looking on the S&P 500 was around 25 times earnings. So that just means that if a stock was trading at $1, or if a stock was essentially allocated through earnings per share, if one share was allocated $1 of profits in a year, they would be trading at $25 per share. That's basically what that means, right? Price divided by earnings. In the last 30 years, that is the highest price earnings ratio we have seen in the S&P 500. So for us to be in the 22 price earnings ratio range, we are obviously very near that. That's why, as you just said, you're hearing a lot of people talk about all-time highs and being concerned about those, and we certainly are too. What's very interesting in this slide is, with the S&P, as we're currently recording this, the S&P sitting at around 6,800. Just a few years ago, the S&P was at 4,800, and the price earnings ratio was 21. And now we're sitting at 22. So what you have to be really careful with these price earnings ratios is you can't let a high PE ratio scare you out of the market. Because if someone got really concerned about a 21 PE ratio 4 years ago, they would have missed, the run up from 4,800 in the S&P 500 to where we are now, 6,800. So you have to be really, really careful. No one can predict the market perfectly. There's a couple other data points that we'll look at here in a minute. But that really stands out. Valuations are very high, and we're paying close attention. That's probably the wisdom to be gained here in early 2026.
Absolutely. Yeah, I think it just speaks to the profitability of these companies. But to your point, I think that's a great example of seeing the price earnings ratio from 2022 to 2025. That is absolutely fascinating. All right, let's transition to this next slide, Michael. I think this one's pretty fascinating when you think about just the evolution and how the market reinvents itself, even just strictly the S&P 500. And I think what's really fascinating is that companies from 40 years ago are not clipping the top 10 in the U.S. today. So, yeah, Michael, probably the same question for you. What sticks out about this slide, and what do you think is important for investors to know when it comes to the market reinventing itself?
Yeah, it's really easy to think of the stock market somehow as like only I don't know, things I've heard over the last couple of decades of being in this business, fake paper money or fake value or value only on paper or value only in a computer or something kind of crazy like that. I mean, these companies, first of all, have real assets. Obviously, as we're going to see here in a second, IT, I mean, most of those are assets that are more hardware, software based than the way our economy was structured 40 years ago. But yeah, you can see the top 10 companies in the United States based on market capitalization. Not one of those companies is listed in 2025. And so the stock market, or just high quality equities, the group of largest equities in our country, whether you want to use the S&P 500 index or the Dow Jones Industrial Average. A few years ago in a market update, we looked at the 30-ish companies in the Dow and how so many of them now were completely different. Gone were Kodak, and I could name a lot of others that just have those companies almost, many of them don't even exist anymore. What you see now in 2025 is almost every single company in the top 10 is an IT company. And the stock market just has this amazing ability it kind of gets its strength from sensitivity. Because the American capitalist democracy system, it is so sensitive, and so the market is so efficient. So when we talk about a market being very efficient and very sensitive, is what we're talking about is dollars flow very, very freely compared to a lot of other countries in this world. So when dollars flow very freely, then a company, you might think about Blockbuster Video. Blockbuster Video lasted a lot longer than Redbox. Redbox was a flash in the pan, just because of how sensitive consumer dollars and how much really are, because as consumers we have so much freedom to redistribute our dollars towards companies that we really want to, companies that produce products, goods, services that we really want to purchase. So there's a real resilience in the market's rotation and reinvention that can be really, really helpful. And I just think that investors need to remember that. There was never a situation, regardless if you go read some old newspapers from decades ago, there was really never a situation in our country's history where you could go buy a basket of 20, 30, 40, 50 stocks and just hold those forever. Back in decades ago, they called it the Nifty 50. And that was just a complete mistake to think that, well, you could hold these 50 stocks and you could hold those forever and you'd be financially independent, as long as you save enough money. That's not true. So you have to be really okay with the rotation and the evolution of the market. It's something that just is so simple that just gets missed so often, I think, even by very knowledgeable investors.
Yeah, I think that's well said. And it's really fascinating to see, because it's even hard in the moment to imagine a world where these aren't the top companies. But we all know when you fast forward, not saying they won't be, but there's a good chance that they won't be if history continues to repeat itself.
That's right.
So
that's right. And the other thing is so simple, and our boys at home are 20 and 18 and 13 now, so I'm starting to teach them more about investing. And as I teach them about investing, I recall lessons and truths that I think in the minute-to-minute news cycle that we live in now, these important truths about investing and using wise investment principles often get missed. Is just even the simple idea of as a stock becomes more valuable from a market cap standpoint, it becomes a greater portion inside of a mutual fund or an index fund. And as it performs worse, it becomes a smaller portion. So you're literally buying more as it goes up, and you're buying less, and you're selling some as it goes down. Even just something so elementary that would never be news on a normal financial news media outlet, and that's okay. That's not really exactly what they're designed for, but that's a really important investment principle. We'll look at that here again in a minute on another slide.
Another thing we're hearing a lot about is just the dollar, the value of the dollar. So we wanted to include this, Michael, if you don't mind to say, I think one in relation to how it's impacted international, almost doubling the S&P, but also just the strength of the dollar over time. What stands out about this slide? And what extra detail would you say is important for investors to know?
Yeah, kind of like what we said at the beginning of this update. With international stocks being up 32% on average, we're using kind of a broad market international index to measure that. And for the S&P, comparatively speaking, the S&P 500 to be up only 18%. That's a 14% difference. A lot of that was related to a decline in the U.S. dollar compared to average foreign currencies of about 9 to 10% last year. There are always concerns about a falling dollar that are sometimes more economic than investment related. But I think the important thing about this slide is that the strength or weakness of the dollar typically fluctuates on longer trends. You can see in this chart, the last time it fell, it was really from 2002 all the way to 2008, a 6 or 7 year trend there. And then from 2008 to 2022, for the most part, the dollar has strengthened. And then since, later 2022, it's weakening again. So I think our expectation would be that history would kind of repeat itself there, that the dollar it might still be in a phase where it's weakening. Obviously, it's impossible to know for sure, but I think we would expect the dollar relative to foreign currencies to kind of move in long-term trends that are 5 to 10 years long. Not even though mostly in the financial news media, they're going to talk about kind of the week-to-week or month-to-month movements. So,
and Michael, what's important about that? Like, why are we even pointing that out? Meaning, from an investor standpoint, if the dollar is getting weaker currently, if that were an assumption, how does that impact portfolios, and how does that impact investors' decisions?
Yeah, that's a great point. I think it's benefited our clients for us to be slightly overweight international stocks. That's one thing. President Trump has signaled that for a variety of reasons, that his administration is, for some goals that they have, they are aiming for a weaker dollar. Now, whether that will happen in 2026, impossible to know, but I think it's important to pay attention to that in some, and for that at least desire of the administration to play some important role in kind of some proactive portfolio adjustments. And that's what we're working on with some of our institutional partners to implement those in client portfolios. And that paid off in 2025. So I think it's important to understand what the current administration is aiming to do, and how that might affect the economy is completely different than how it might affect an investment portfolio.
Yeah, that's great. Moving on to this next slide, one of the other things that we're looking at historically is consumer sentiment. So, Michael, this chart goes back 65 years. And one thing that you say a lot that I love is, we don't really worry about bad years on this team. Even 2022 was a bad year that a lot of people have already forgotten about, but what we really worry about is bad decades, and how those stack up and how they can really impact investors in all stages of life. So, what stands out to you about this slide and consumer sentiment as it relates to today?
Yeah, this is a fascinating one. I think we got this from the University of Michigan. When we talk about worrying about bad years versus bad decades, what we would want investors and clients to remember is that roughly 1 out of every 3 decades in the stock market, U.S. stock market, is pretty rough. As in, what does rough mean? A roller coaster where you pretty much earn nothing or very little for about a decade when you net everything out. When was the last one? The 2000s. It was technically 2000, roughly 2000 through 08. The one before that was, let's just call it for today, mid-60s to mid-70s. Mid-1960s to mid-1970s. The one before that, Great Depression, which is, let's just call it for today, essentially the 1930s. In between those bad decades, you get mostly good times. And so the way the stock market has averaged about a 10% return over the last century is you get about 0% during the bad decades, and then you get about 15% on average annual return during the 2 good decades, or 25-year good period. You average all that out, you're going to get about 10%. It's really fascinating to me with this slide that the two peaks in consumer sentiment since 1960 almost perfectly coincide, is a dangerous statement, but almost perfectly coincide with the beginning of those bad decades. Now, we'd be the first to say that you cannot predict exactly when this next bad decade is going to come. However, it is important to pay attention and to make some portfolio adjustments accordingly. But I'll just kind of state that again. You can see in the top left of this chart, there was a peak in consumer sentiment right in the mid-1960s that preceded a really rough decade in the United States stock market. The peak on this chart is around the year 2000, 2001, which again preceded that next bad decade. So what we're coupling this with is a lot of talk about all-time highs. We're considering high PE ratios, but we're looking at consumer sentiment being very, very, very low.
Mm-hmm.
And this actually starts to make sense when you consider that we had low consumer sentiment in the 90s. We actually had low consumer sentiment in the late 2000s, early 2010s. And all that really meant at the time was that the long-term secular bull market had longer to run. So that's probably what this data means. We have to be really careful about trying to predict the market perfectly. But what we would look for, to be clear, is high PE ratios, a market that has run longer, very high consumer sentiment, all kind of coupled together with one more thing we'll look at here in a second. Then you start to get even more clearer indicators that the long-term bull market is starting to have perhaps come to an end.
I would like to look at this, the all-time highs. Michael, we looked at this
Yeah.
slide last time. I think this is very fascinating because, it's very normal for consumers to hear all-time highs and actually get scared.
Yeah.
And start to want to pull back. And, even if we've looked at more recent all-time highs, if you miss out on the upside, how dramatic that can be on the effect of a portfolio. So I think it's worth revisiting this, and again, maybe stating what stands out in kind of these clusters of all-time highs and how we generally see them lumped together.
Yeah, I think you stated that well. The concern that an informed investor would understandably have right now in early 2026 is, has this bull market made its run, and are we now in danger territory? Or to your point, Kevin, do we have more room to run? And because, as we pointed out at the beginning of the update, we need pretty much everything the market will give us to combat the risk of inflation. So yes, we did talk about this in the last update. I just think it's important to note that we had 1, 2, 3, 4, 5 years in the late 90s with anywhere from 30 to almost 80 new market all-time highs clustered together. So 30 to 80 all-time highs per year for 5 years. Whereas just in the last 2 years, we've had roughly 30 to 60 all-time highs, but it's only been in 2 years. So again, combined with the other data points we just talked about, we would look for perhaps a longer string of years where you've got a higher quantity of all-time highs. 5 years of all-time highs, a significant number versus just the last 2 years. So another data point to pay attention to as we seek to manage, generate high returns, but also to manage risk, which is a good segue to these last couple slides.
Yeah, absolutely. Well, yeah, we'll look at the returns, and the next few slides are really about risk management and related to returns too. So this slide's pretty fascinating. The arrows as they follow just the S&P 500 mixed in with other sectors of the market like energy or technology as an example. And so, Michael, one thing I've heard you say, and that we repeat, it's by being diversified, you may not make a killing always, but you will not get killed. And so I think this slide kind of dictates or demonstrates how history has played out and how the S&P, as an example, gives you a little smoother ride. But would love to hear you tell people a little bit more about what you see in this and what you think the important takeaway is from a risk management standpoint about diversification.
Yeah, I really do like this slide a lot. We've never shown it in Market Update before, never really thought it was important. There was something about the way this one was laid out that made a lot of sense. And our exceptional team member, Bradley, has added some things to this slide that are very meaningful. If you look at the black lines, again, like you said, Kevin, this is just returns by sector going back 10 years. There are roughly a dozen sectors in the S&P 500. The top line is the top performing sector each of that year. The bottom row or bottom line is the worst performing sector that year. Over to the right, if you look really, really closely, or if you're just listening, you can piece this together. Information technology averaged 22% over the last 10 years. Energy averaged about 5% over the last 10 years. So these are two significant sectors of the S&P 500 that have drastically different average annual returns over the last 10 years. Yet these black lines that Bradley put in essentially just track the S&P 500. And it might look a little mediocre, almost like you're missing out on high returns. And yet if you look at the last two columns of this chart, you'll notice that the S&P 500, just by having the way just a normal S&P 500 index fund would be allocated, compared to all the other sectors, you actually got above average returns, and you actually got below average risk compared to just all the sectors. And so that's just really, really important. We've talked up to this point in this market update about how we are pretty sure this market has more room to run. We're trying to generate returns. We don't worry about bad years. We worry because recoveries come quick, as we'll look here in a second. We worry about bad decades. But there are essentially two ways to manage risk in a portfolio, and one is through diversification. The other one we'll talk about here in a second. So the diversification of just something so simple as an S&P 500 index fund is actually very fascinating. it's very important to maintain the resilience of your portfolio. Obviously, almost all of our clients have other significant holdings besides just an S&P 500 index fund. But given that we cannot control the market, we can control what we're invested in. We have to maintain really strong resilience and risk management in the portfolio, and diversification is this is just one very clear, nice, easy example that kind of highlights how diversification helps. Essentially helps an investor by not hurting, basically.
Yeah, I think that's well said. and the other thing that you're alluding to was asset allocation. So from a risk perspective, obviously it's, okay, we just talked about sectors, what we're actually invested in. And then, the more obvious one that a lot of people think about is just allocation. And obviously when we say allocation, generally people think about stocks and bonds. And so, Michael, maybe just say a little bit more about this slide and how allocation over historically has helped investors be able to manage risk.
Yeah, I recall back in 2008, early 2009. We'll look at this again here in a second, but the market gets cut in half, and very knowledgeable, smart people were claiming that it would take the market a decade to recover. And yet there were some really smart advisors that I had the good fortune of being able to be mentored by from afar, that looked at history and said market recoveries take sometimes months, sometimes years, but never decades. I can specifically remember talking at a couple of CPA conferences back in the day, and basically using data points from the early 2000s, mid 60s to mid 70s, the Great Depression, and you could almost chart out what a recovery would really look like if you applied the logic of Mark Twain, that history doesn't repeat itself, but it often rhymes.
Yeah.
And people would have all kinds of just fascinating emotional reactions to that type of talk. And I was relatively new in the business because I've gotten into the wealth management business in 2005, and here we are 2008, 2009. So, but it was a fascinating time to walk through, and it's even more fascinating now, it's 2026, to see all of that essentially come to fruition. You look at this slide right here, the average 10% decline in the S&P 500 takes about 10 months to recover. The average 15% decline takes a little over 15 months to recover. The average 20% decline in the S&P 500 takes a little over 20 months to recover. And so sometimes it takes months and sometimes it takes years, but it doesn't take decades. And I think that's important for especially a lot of our clients who most of our clients are retired. How do they keep their sanity and have financial peace and clarity while they're retired and drawing essentially a paycheck from their portfolio? These are important truths to remember. So I think that's important.
Yes, one thing I've heard you say quite frequently is the market doesn't come back fast, but it comes back faster than we think. And I think every time you look back on that, even 2022, I like to bring that as an example because people have already forgotten. But the market, the S&P was down over 25%.
Yeah.
And it took less than a year to get it back. And then obviously so 23 was a great year, 24 was a great year, and 25 was a great year. But I think that's one thing I think about. It's, you could say, sure, 10 months isn't fast to recover, but it's generally in the moment. A lot of investors will think it'll take years.
Right.
And so I think it's important to remember that and what history will teach us versus actually how we feel in the moment based on economic data or what the news is telling us.
Yep.
Well, let's transition from this to, again, reflecting back. Let's not look at, let's look at the worst crash of our lifetime. Again, I think we don't think this is right around the corner by any means, but it's good for our investors, especially those retired clients, to be reminded of, worst case scenario planning. And so if we look at this data, really looking at the crash, how long did it take, and what has history taught us? Michael, when you see this, relate this back to our investors, what we think is an important takeaway, and maybe even how we think we're already prepared for them.
Yeah. Yeah, the Great Recession, 2008, market bottomed out, depending on how you want to calculate it, March 6th or March 9th, 2009. It was over a 50% decline. And yet, as you can see from this chart, this is an interesting one because it was an over 50% decline, but it didn't take 50-something months to recover. It actually took less than 40 months to recover. And so we were just talking about, I remember conversations in '09 and people saying all kinds of things about, the market's going down. I don't think I think the smart thing to do from an investment standpoint is to never expect it to go up again. I mean, these are smart people that I'm talking to, in 2009. And yet, as we see, as we all know now, perhaps the greatest long-term secular bull market in stock market history started basically 17 years ago, this March. Mm-hmm. And so when you think about whether you're still working or you're retired, there's essentially two risks that you have to manage. You have to manage the risk of your portfolio going to zero, and we do that through diversification. But you also have to manage volatility, and we do that through asset allocation. And so if you're a retired investor, how do you have financial peace? Well, if the worst financial crisis of my lifetime, it took the market about 1.5 years to go down and 3 years to come back up. That's 4.5 years. Let's round up. Let's say it's 5 years. Then in my portfolio, if I'm a retired investor, I probably do want 5 years worth of withdrawals in something that in 2008, the worst financial crisis of my lifetime, might have stayed steady or gone up. That might be conservative fixed income and conservative bonds, cash, something along those lines. So these are things that we're already proactively doing as we look out for our retired investors. But essentially, managing risk so that a portfolio doesn't go down to zero, managing volatility, and then managing inflation risk is ultimately the last one. We've said this before, kind of jokingly, if there was a better way using liquid investments to manage inflation, then I would tell someone to run to that type of investment. Having a diversified, properly allocated portfolio of publicly traded equities is a little bit like what Winston Churchill said about democracy. It's the worst form of government known to man, except for all the others. Mm-hmm. So sometimes a diversified portfolio can feel that way, but it's the best solution out there for someone trying to reach financial goals like retirement or stay in retirement and retain their financial independence. It's the best liquid, investment option that we've been given to essentially manage risk and manage inflation.
That's great. I think fundamentally, we'll continue to rely on history because, it's definitely our best guide, and we're firm believers of that. And so I think the 5-year rule is really important. It's something that we talk about with a lot of our retired clients, and also when we forecast our clients who are not retired but about to retire, their returns over time. We can't always count on 10-12% returns because we'll have to make a portfolio more conservative. So I think that's one thing that we often talk about with our clients and for long-term projections, no matter which bucket you sit in. Well, thanks for listening. We'll leave you with this quote from Ben Graham. And as you can see, it says in the short run, the stock market is a voting machine, but in the long run, it is a weighing machine. All Ben was talking about is short term. The market trades based on speculation. That's why we see a lot of volatility. Today would be even an example. There's fear out there about what's going to happen with interest rates and tariffs and everything going on in the world. But long term, these aren't just stocks that are phantom, right? They're ownership of good businesses, and so they will trade based on earnings and cash flow and the assets that they have. So I think it's just a good reminder for our clients listening as they experience volatility. So thanks for listening. There is a link below if you'd like to subscribe, or if you have any questions for us, you can reach out at the Purefoy Wealth team at sagespring.com.